are. And so we've got our next thing, the benchmarking analysis. Mike has been here before with us. A couple of us have seen this before, and there's an awful lot of information. And so, Mike, I'm going to just turn it over to you, and you can get started.
Thank you very much. It's good to be back, even if only back remotely and not in person. I understand that I'm driving, and so I will share the host is disabled screen sharing. I see that some of you, so I can't screen share unless that's enabled. I see that some of you do have the paper copies in front of you. So if that's not possible, I can drive on without the screen sharing. But
we'll get Dan to look at that for us in a minute here, or Peggy.
Gonna take care of it.
And so, but why don't you go ahead and start, and then we can see what we can do later.
Okay. Well, we do performance and cost benchmarking with a detailed emphasis on costs, and we do it on an annual basis, and we compare your results to the U.S. public universe and a custom peer group of funds. And I'm just going to pull up on my screen because I see some of you have paper copies there, and I've clicked through to page. First page of the executive summary of your results. So you're looking at our database, the universe of participants, 190 funds in the database at the point in time when we did your report. That's a little bit down from normal, but this is not normal times, as we're all aware. So we expect that the database will reach the same levels as last year, but we're a bit slow because of COVID. But the most important thing is that there is critical mass in the database for the purposes of doing a good assessment of your results versus the U.S. public universe, and for costs versus your peer group. As I go through this, please fire away if there's questions or discussion points that you'd like to raise. Everybody hear me okay?
Yeah, you're coming in clear here.
Oh, okay, sorry for that, but I just want to make sure that I'm not babbling to myself as I do this. So if we're on page 2, this is the demographic sketch of your peer group. It consists of 15 U.S. public sponsors ranging in size from 2.5 billion to 19 billion. You're the median sized fund of 11.2 billion. And that's by design. The idea is that funds that are close to you in size have similar economies of scale and similar implementation abilities across the asset classes. And both those have a big impact on costs, so it makes for a better assessment of your costs. And for the cost analysis, we will focus on your custom peer group. Because of the Freedom of Information Act and the risk that somebody in the public would get access to the names of the peers and cite them, their performance relative to yours inappropriately, we don't disclose the peers publicly, but we have provided those to management so they're available to you if you would like to know the specific names of your peers. We're going to start by looking at your net total returns for the 5-year period ending December 31, 2019. This is on page 3, and it shows each of the component years. Your return was 7.37%, which was very close to the public median of 7.46 and equal to the median of your peer group of 7.37. And just to explain the chart quickly, your value on this chart and the next few pages will be the green dot. The box and whiskers, which define the quartile breaks in the median, is set relative to the 42 U.S. public funds that are in our database at this point in time when we did your report, and the peer median is the red bar. Now there's 2 components that drive your total return of 7.37. One is policy return, and that's the contribution from asset mix. The second is implementation impact, and that's the contribution from active management relative to that asset mix position. Asset mix is by far and away, or policy return is by far and away the most important driver of total returns. Over the long haul, it drives about 95% of total returns. The next page takes a look at your policy return and how it compares to your peers over the period. So this is the return you would have generated if you had invested in your benchmarks, and your peers in the universe policy returns are the returns they would have generated if they had invested in their benchmarks according to their policy asset mix. Your policy return of 7.7% is quite high in the US universe. It's well above the US public median of 6.9, and that's equal to the peer median of 6.9% over the period, and that's in the 90th percentile. Now, there's a note underneath the chart that explains what we've done to level the playing field for private equity. And what we've done is we've applied a standardized default benchmark that consists of a lagged blended small cap public index to your policy returns and everybody else in the universe. The reason we do that is because self-reported benchmarks for private equity are extremely diverse. And because they're so diverse, they generate noise, a great deal of noise in the database, and it makes it makes for a rather arbitrary split between policy returns and implementation impacts when we use self-reported benchmarks. So this makes for a fairer, more level playing field kind of comparison for both policy return and implementation impacts and the private equity asset class. Page 6.
Jim, well, excuse me, Mike.
Yes.
Jim, go ahead.
Mike?
Yep.
A question. So on the equity side, this is our US, our international, and our private equity all rolled up.
I'm on page 4, and the note that I described about your benchmark just applies to your private equity portfolio. We're using your reported benchmarks and what your peers and the other funds in our universe report as their benchmark for the various public equity categories, because there's far less noise generated by differences in benchmarks. And those benchmarks all tend to be public market based.
I think I understand it, but I just like, I read this earlier in this other report, but I didn't follow all of it. So on the US public returns, that's what we're looking at on page 4. So this would be a US equities as far as our private.
It's all ours.
This is,
No,
this doesn't have fixed income stuff on it. This is all like.
The chart is the total return for the universe, and you're the green dot, so that's your total return.
Everything that was.
That's the policy.
I'm sorry.
It's the policy return on this page, but the footnote just sorry, and I misunderstood you. Just refers to the special treatment to private equity only.
I'm clear.
Yeah.
Thank you.
The next page gives an explanation of why your policy return at a high level was higher than the US public median of 6.9% over the period. And there's two components. One is what was your average policy asset mix over the period, and differences in your benchmarks relative to others can contribute. And there's two factors that stand out for you driving your higher return. One is you had higher weights in US public equity, and a higher benchmark return in US public equity. And US public equity has been a very good performing asset class over the last 5 years. The second factor is that what you don't have. You don't have hedge funds, and hedge funds has been a poor performing asset class over these 5 years and over most time periods in our database. The next slide looks at implementation impacts. And yours was minus 38 basis points compared to 10 basis points for the peers and 40 basis points for the US public median. This is a much smaller contribution to total returns. And there are reasons why there can be differences that relate to differences in the benchmarks that are used. And again, the private market asset classes tend to be more problematic for generating noise. We have neutralized that effect in private equity, but notwithstanding that, there can still be noise in these numbers. When we look at the next page, page 7, and this is your 5-year net returns and implementation impacts for the major asset classes. And all public equity and all fixed income are aggregated up to a fairly broad bucket here for simplicity. You can see that your all stock return, your real estate returns, your private equity returns were better than the US public average. You're the dark blue bar, and better than the peer average. All fixed income is a little bit lower. That's likely a result of differences in the components of your fixed income program relative to peers over this time period. And then in the bottom chart, you see the implementation impacts relative to your benchmarks for the same categories. So just slightly negative for stock, fixed income, and real estate. I would point out, though, that your real estate benchmark is substantially higher than the benchmark for your peers and for the US public average. So with that kind of a private asset, I would lean more towards the return as being indicative of your relative performance. And your private equity implementation impact is larger than both the universe and the peer group, and that's in line with your outperformance in terms of returns over the period. Next, we're going to look at costs. So I'll pause here just briefly to see if there's any questions related to this part. If not,
yes.
Yeah.
Mike, this is Bruce Nelson. Could you maybe do just a little bit more explanation on us compared to the universe and the peer group on all fixed income, please?
Yeah, I don't know that I can. I've had a discussion with management. Remember that the all fixed income category here is an aggregation of the various sub asset class categories that you hold, and that's not the same as the sub asset class categories that your peers or the universe may have held over this period. And my understanding is that you may have been less exposed to credits over the period, and probably the duration of your fixed income portfolio may have been shorter than the peers in the public universe over this particular time period.
Okay.
Bruce, this is John. Remember that we, under Joe, went to kind of the various fixed income buckets, which were primarily intermediate duration buckets. So we were lower duration. We leaned away from credit and some of those things, as Mike said. And so versus our peers who were still benchmarked against a Barclays Ag, which would be pretty typical, we would have been lower credit, lower duration, both of which have done very well over this 5-year time frame that we're talking about. So that's, I think, primarily where we look different than peers there.
Okay, thank you. And John, appreciate that, longer perspective. I've got a year and a half looking at this and appreciate that. Thanks.
Sure.
So next is page 9 and the cost piece. And this table summarizes your total costs for 2019 at 62.2 million or 55.7 basis points. It's broken out by asset classes and whether they're managed internally or externally. And along the inside the internal management, you'll see a column for internal costs related to the oversight of the external programs. And in the bottom part of the box, you'll see the oversight, custody, and other costs related to the management of the asset pool, totaling 2.2 basis points. Now, you provided carried interest and performance fees for private market assets. They're shaded in gray. We have not included them in the cost benchmarking exercise. The primary reason for that is that we do in some jurisdictions and for some funds, but only about 1/3 of our clients at this point in time are providing us with carried interest. So we're benchmarking all your base fees and all your internal costs, but not the carried interest portion in the analysis as we go forward. This slide on page 9 shows you the green dot relative to the distribution of costs in your peer group. You're below the peer median of 61 basis points, but what I want to draw your attention to is how the cost in the peer group range from about 40 basis points to almost 90 basis points. And asset mix is far and away the biggest driver of that. And so the funds that are closer to the top of that distribution will have heavier weights in private market assets and hedge funds, which are considerably more expensive than public markets. And typically the funds that are skewed down lower will have less heavy weights in private markets and be more public market focused. You can't use this chart to assess whether you're operating cost effectively. So to do that, we generate a benchmark cost calculation which follows. But I thought I heard somebody raising a question. If not, here's the result of that benchmark cost calculation. It shows that you're coming in at 0.5 basis points or 596,000 lower costs than what we would expect in 2019 to run your program. And the way to think about this benchmark cost calculation is as if we gave your asset program to your peer group and asked them to manage it on your behalf. So we apply peer median costs to everything that you do to calculate that benchmark cost. And the next several pages get us into a detailed attribution of why you are low cost. And first at a high level by the two major factors on page 11. One is, are your implementation style choices higher or lower cost? And for you, they're lower cost by 2.6 basis points or 2.8 million. And we'll get into each of these factors in a little bit more detail on the following pages. The second factor is, are you paying more or less than your peers for similar services? And you are paying somewhat more for your external investment management costs. Somewhat offsetting that is you're paying somewhat less for the assets you manage internally, as well as for oversight, custody, and other costs. So we're going to start by looking at implementation style on page 13. This is one of our trademarks, overly busy slides. But I'll work across one line just to illustrate the math, and the point of this is to make it transparent and not a black box process for you. But the first part of the table looks at passive versus active. And passive is less expensive than active management. So if we take the second line, stock Acqui ex-US, you have about 1.9 billion of assets in 2019 on average. You have 28% more passive, or almost 29% more passive in that category than your peers. And under column C, the cost differential between active and passive in that category is 38.2 basis points. So multiply A times B times C, and you save 2.1 million because you have more passive Acqui ex-US stock than your peers. When we look at internal versus external, you have a big saving here because your fixed income program is primarily internal, and internal is less expensive than external management. And that saves you 2.776 million. For evergreen versus limited partnerships and other ways to implement private assets, another term for evergreen that you may be more familiar with is open-ended funds. They are less expensive than limited partnerships structures, and you have less open-end or evergreen type structures in your real estate and natural resources, so that costs you a little bit more. The final part of that table, you have less fund of funds in real estate and private equity, and fund of funds introduces a secondary, an additional cost layer, so you avoid that more than your peers, and that saves you about 1.4 million. And you have less, you don't use overlays. Some of your peers use overlays or derivative programs to a certain extent, and you save almost $500,000 there. Next, page 14 looks at, well then, what are you paying for external asset management categories? Passive and active and privates and publics, isolating them here. And here you do pay 4 basis points more in total. You pay more in stock, US broad, you pay more in stock, Acqui ex-US active, and real estate. I would point out that your performance is also good in these areas. Our view is that paying more is not inherently bad if you're comfortable that you're getting reasonable value in return for where you're spending money. That's fine, and your performance is quite good in those 3 categories where you are paying more. You are paying less for your private equity, both in terms of the underlying base fees in your fund-to-fund program and your LP program. Next piece looks at your savings internally. This is mainly your fixed income program, US, and your cost is 1.1 basis points versus 2.6 for the peer median, so you're saving 362,000. And the last piece is how your costs compare for oversight, custody, and other. And here you save 1.6 basis points. We aggregate them to do the benchmarking because there's trade-offs between these categories. You can do, outsource more to consultants or do more internally, for example, or have your custodian do more or less. So it makes more sense to look at them in aggregate, and you are saving quite a bit. There's also a footnote that relates to the fact that you have a relatively complex investment platform, and that puts upward pressure on your custody costs relative to your peers who have less complex structures than you do typically. And page 16 pulls the implementation style impacts and whether you're paying more or less for your asset class categories, as well as the oversight, custody, and other line, and combines them. So you can see what the net impact is for each asset class. And of course, that differential across the whole fund is 5 basis points. And you can see where the big savings you get are in the fixed income category, as well as your diversified private equity program and the oversight, custody, and other. Last slide, key takeaways, what we've just gone through. Your returns over the period, very close, aligned with the US public median and the peer median. Your policy return is high relative to both and in the 90th percentile. Implementation impact, a little bit lower than your peers and the US public median. Some of your benchmark choices can have an influence on that result. In particular, your real estate benchmark is a tougher hurdle than your peers in the US public median have. And your cost performance is your slightly low cost relative to your benchmark cost, or what we would expect your cost to be given your asset program relative to your peer group. And driving that was the fact that you have a lower cost implementation style. That's the conclusion of the presentation. Are there questions or discussion points you'd like to raise?
Mike, you probably did this on the key takeaways, but if you were going to give an elevator pitch on the key takeaways to somebody not too sophisticated, what would be the elevator pitch that you gave us in this report?
Well, you know, I typically costs are underestimated as a driver of value for pension funds, or a differentiator of performance long term, and your costs are reasonable and continue to be reasonable, and that's an important differentiator. So I think that would be the and that's what we do. That's unique and in the most detail. So I would say that that's an important factor for your fund.
So one thing for the board to remember, this is through calendar year 2019. It doesn't tie to a fiscal year. So if you go to page 16, you'll see global TAAs. You'll recall at the end of calendar 19, we eliminated that in our portfolio. So going forward, that cost will be reflected. That'll go to zero. John has restructured the fixed income portfolio back to the aggregated pool. So we should see some better costs there. So it's not like we're frozen in a place in time, but based on the 2-year window that we looked at, we've got a great story to tell the legislature relative to our costs and our returns. But we've also got, we know where our weak points are, and we've been addressing them. John, anything to add on the fixed income side?
No, I think you said it, and I said it before. I guess I would just note, consistent with what Mike was saying, where you do see differences here, it is generally our implementation. I was mentioning to Terry, as we were on mute here, that, for instance, in domestic equities, we're in, say, the 130/30 funds, which would be a little bit more expensive than just a straight active manager potentially. Or we might be more value add type managers within the real estate portfolio, which, as Mike noted, we've realized value there in terms of return, but they're more expensive than perhaps being in a core manager with an open-ended fund. So where you see those things, I think there's, kind of line by line ready explanations that myself and the directors have sort of talked about, and I think we understand where those things are coming from and are comfortable with it.
Other board members, questions for Mike? Will be a test, Jim.
Pass, fail, or will be graded?
Pass, fail.
Well, that is a grade, pass or fail.
Also, I'd be remiss if I didn't point out that RVK's consulting costs are a big contributor to our efficiency.
Yeah, your consulting costs are low, so a shout out to them too.
Good. Anything else, Mike, that we should know?
No, I think that those are the relevant points. Thank you for your time and thank you for your business. I hope to next time to see you, to be there in Helena and see you all directly.
I'm gonna, sorry, Mike, question. You folks, this is your entire business then, advising pension plans on their cost structure? Is that singularly what your company does?
Yes, we technically don't provide advice. We're an information or data company. So benchmarking of pension funds, both on the investment side and on the pension administration side, is our entire line of business, yes.
And RBK, do you guys work with these folks on some other plans?
I believe Becky and Jim can comment on that. I don't, but I think Becky's nodding her head.
Yeah, we do have several clients that receive an annual or semi-annual CEM report.
Yeah, and we've worked with Mike before, not just here at Montana, but in several other places, or his colleagues. So we're very familiar with their methodology and their approach.
One more question, Jim Voitkov, then for you guys, Becky. Would you judge that our report here on a relative basis for other plans that you work with this same organization, do you give us high marks?
You get a gold star, both on performance as well as the overall cost of the program. So it's always that balancing act where, your asset allocation is very much the reason why, in addition to, good implementation decisions, why you look competitive on fees. And because your asset allocation structure has done so well, other plans that are more heavily invested in alternatives, for example, get reports that says their fees are a bit higher and the performance isn't as good. So there's a lot more discussion that happens after the CEM report in those cases. But no, you definitely get a very favorable rating for your CEM report.
Yeah, I would agree with every one of Becky's comments. The only thing I would make sure that I would emphasize that Mike said several times along the way is, one, costs are important in the long-term performance of a pension plan. But number two, more important is what you get for the costs you expend. And as he said, higher costs are not a problem if you're getting more than commensurate returns to the portfolio for it. So it's very important not to fall prey to sort of compartmentalized thinking that lower is always better. It's only always better if you can maintain adequate, if not superior performance, which you have done. And I agree with Becky that, we would interpret Mike's report card, benchmarking report card, based on all the other funds that we've seen, and we've seen many, as being a very positive one. So I'll stop there. And I won't say anything about low consulting fees. I'll leave that to Dan.
I just put the ball on the tee. You can swing if you want, my friend.
I think I
If you're
just did.
Yeah, if you're concerned about those low prices, we'll talk, Dan.
Okay, so I think that concludes our benchmarking analysis. And so we're going to move on to the investment consultants, RVK. I see Becky, Jim, and Mark are on the line.
I'll excuse myself.
And so thank you, Mike. And so I'll turn it over to you, Becky, and you guys can divide up your time however you think it'd be most productive. But I do want to say I appreciate all three of you being here, and we look forward to your presentation.
Well, we can't wait to be with you in person again. We look forward to that, and thank you for the Zoom accommodation. I have to tell you, relative to the other clients that we work with, you have one of the best systems and the best camera. So very great work, Dan, on the infrastructure. I appreciate that.
Peggy, you just got a compliment.
Well, Mark is going to lead us through the performance materials today. We didn't want to do a lot of handing off because of the technology, and Mark will do a great job, but don't be surprised if Jim or I interrupt with a comment or two, or certainly we're all three here available for questions. So Mark, I'll turn it to you.
Great. So I'm experimenting with a green screen behind me. I don't know why it's turning my face red, but I wasn't for 5 hours yesterday. But anyway.
So you're not embarrassed with what you're saying.
Yeah, well, yeah, I guess it hides a blush if I get embarrassed. That's a good
There you
thing.
go.
So if you turn to page 139, I'm going to do a quick run through capital markets. But
In our, I think that's a different page, isn't it?
So you're on the big book or the summary book?
so I'm going off the meeting materials.
Oh, so the PDF version is different than what we got. So if you're on,
You know what? I can go off that if you want. I have that as well.
do you want to screen share? Would that be better? So we're on the page.
Yeah, that might
you're
be
on?
easier. Why don't I do that?
All right, Lindsay, I will screw it up if I try. So will you give Mark the ability to screen share? Mark Higgins, not Mark Nonig. We don't want to know what's on.
All right. Do you
There
have?
we go.
Yep.
Okay, great. Let's see if I can move it. There we go. So I'll start with just kind of capital markets and obviously there's some news in the economy. Just pointing you toward the executive summary. I think you know this, but in terms of preparing for a meeting, we find it helpful your time is very limited, and hopefully this will give you at least 70-80% of what you need to know for the meeting. In terms of capital markets, I'll keep it relatively brief, but the second and third quarter thus far have been quite the recovery in markets. The S&P 500 up about 6%, the Bloomberg Aggregate Bond Index up about 7%. International markets have lagged a bit more. They're still down 4% for the year. Real estate was still down for obvious reasons, given what's going on in the retail environment and office space. So that was down about 10% in terms of a broad REIT benchmark. And really the story, people were, including us, were pretty perplexed by just how rapidly the markets recovered in the second quarter and thus far in the third quarter. The COVID pandemic really obviously created an economic shock of a magnitude that, while not unprecedented in history, it's certainly unprecedented in our lifetime. You saw a major contraction of GDP at 33% annualized. One important thing to note, because you haven't had a GDP decline of this magnitude, it hasn't been as relevant, but the way GDP is calculated essentially is to take the quarterly decline, assume it continues for 3 months, and that is the annualized decline in GDP. So economic activity did not decline 33% from the previous quarter. It declined in the upper single digits. But when you annualize that's what that annualized figure is. It's still bad, but it's not 33%. And then double-digit unemployment is certainly a headwind as well, as everybody knows. The problem that has occurred in the past, and which was very different in this situation, if you look back to the Great Depression, it really took a long time for the Fed and the government to really get the right policy mix of fiscal stimulus and monetary accommodation to get the economy out of the panic and credit contraction cycle. They learned from that in 2008 and 2009. It took about a year to kind of get our hands around the problem and get the right policy mix of fiscal stimulus and monetary stimulus to get the economy back on track. But then in 2020, it took us about a month. So once the once the rails came off in terms of COVID getting out of the bag. There was several trillion in asset purchases from the Federal Reserve. There was a return to the 0% bound on interest rates, and probably most importantly, there was the $2.3 trillion CARES Act. So what this really did, you had massive deflationary pressure, massive asset sales, panic, and this really stopped it and stabilized the economy. And it was really, if you look back through history, it was the speed, not necessarily what happened, that the speed of the reaction by the government, rather than something being unique about this particular event that enabled the recovery to occur so well, thus far, so fast. In terms of outlook, I'm relatively young, but at least in my limited career, I haven't seen this much uncertainty, not only on the economic front, how COVID is going to play out. Is there going to be long-term damage to the economy? Are there going to be structural changes that occur as a result of this? There are a lot of questions on the economic front, but probably more importantly, there are questions on the policy front. So we've had quite a bit of stimulus. We have another package that is being debated right now, but how the government reacts, it's pretty clear how the Fed's going to react, but how the federal government is going to react, also with an election coming up, and how that will shape the future as well. So, I mean, our message to clients is pretty consistent with the past, but I would say we're probably emphasizing it a bit more now, which is you have a strategic asset allocation for a purpose that matches your long-term objectives. Now is the time to stick to that to the extent that policy allows and opportunities allow to rebalance to that target. But now it is a particularly difficult time, not that it's ever easy, but a particularly difficult time to see where this economy and where government's reaction to the challenges that we have are going to land over the next couple of years. So that's kind of the basic message at a high level on the economy and capital markets. Why don't I pause there? Is there anything that I missed? Anything that seems off that anyone has a question on? Okay, great. Well, why don't we skip ahead to, sorry, I'm going to be going back and forth between my paper copy and this, but on this page, you can see the overall performance of their retirement plans. Some of this is going to be a little repetitive because you got a glimpse of this already with the CEM report, but going out to 7 years, you're roughly on target with your benchmark. You underperformed by 6 basis points net of fees. This doesn't go out to 10 years because there was kind of a starting point for this benchmark that's not quite at 10 years. But generally some of this is noise, which we'll get into, but generally over the up to 7 years, you've been in line or outperforming the benchmark on a net of fees basis. If you go down a couple to 4 rows down, you can see the gross of fees return. And this is what we use to benchmark versus peers because the peer universe that we use doesn't provide net of fees return, but you've essentially performed very well relative to peers in the top quartile or top decile out to 10 years. Now out to 20 years, you're well ahead of median in roughly in the top third. And since inception, which is more than 25 years ago, you're right about median. Now, for those of you who haven't been on the board as long, these looked very different 10 years ago. I think you were in the top bottom quartile or bottom decile even over 10 years. So a lot of the changes and improvements that have been made have really paid off over the past 10 years. If you move on to, oh, I'm sorry, I'm going to have to move you on. So page 5, we provide a glimpse of your cash by looking at the different places that cash is present in the portfolio to give you an overall sense of what that cash position is. You're at about 2.65%, which has come down quite a bit from where it was last year, as those of you who on the board remember. Let's go to page 6. Oh, sorry. It's just a quick glimpse of the total assets in the across all of the asset pools that you have. You have about almost 20 billion in assets now, and most of that, as you know, is in the consolidated asset pension pool, but also quite a bit of funds in the short-term investment pool and trust investment pool. Moving on to page 7, you can see the relative performance of these different pools. The capital asset, the consolidated asset pension pool. Again, this is going to be similar to what you saw previously, but that has solidly outperformed its index on a net of fees basis. Since inception, we just started tracking that pool separately in April 2017. And again, this is the pool of the retirement plans investments that excludes the cash portion that is used for liquidity. The trust funds investment pool has also performed well. It's dipped a little recently. What it's really benefited from, in addition to skilled management and fixed income over the long term, it also has a real estate component to it, which, as you know, is increasing, and that has aided performance over the past 10 years. And then the short-term investment pool, it's performed well. I guess the main thing to highlight there is you're getting used to some higher levels of income relative to what you experienced for quite some time after the 2008-2009 financial crisis. For obvious reasons, that's going to start going back down, given that the Fed has cut interest rates down to the zero bound and started purchasing assets again to push the yield curve down as well. Why don't I pause there? Any questions thus far?
Ethan, any thumbs up on the real estate trust fund stuff, or you gonna let that one fly by? He didn't give me a thumbs up emoji. So.
But thanks.
I think I missed that, but.
Can you guys hear me?
There you are.
Yeah, I don't have anything material to add, but thanks for the window of opportunity.
You looked like you were sleeping is all he was doing.
Thanks, Ethan.
I assure you I'm wide awake on the beach.
Moving on to the next page, you can just see the total division of assets by the different asset classes in the portfolio. The biggest asset classes are the two equity pools and the fixed income, followed by private investments and real estate. The next page shows the asset class returns for the different asset class portfolios. Page 9. I'm sorry. Again, the domestic equity pool, and this was reflected in the CEM report as well, has really been the engine of your portfolio over the past 10 years. You can see it's on a net basis returned about 13.2%. That has underperformed relative to the broad index against which it's benchmarked. But having that, you have, as you know, shifted more and more into passive. U.S. equity has been an especially challenging, and I know you went over this in the last meeting, but has been an especially challenging area to outperform. While you still underperform, that passive allocation did make a difference. There are a lot of plans with much more active that had much more severe underperformance. So again, it's still been difficult, and even with that passive, you've trailed the index a bit. There's some also that's an element of small cap exposure in the portfolio, but generally you've improved performance relative to peers by moving in that direction. The second asset class is international equity. The two noteworthy things about this investment is, first of all, you benefited from not having as much as your peers do. US equity. If you look at over the last 10 years, international equities provided a positive return, but it pales in comparison to what you got from US equity. And having that overweight to US equity has really boosted your returns quite a bit. You have outperformed pretty consistently, net of fees. Randy, I know we'll talk about this in reading his materials, having some growth orientation in the international equity portfolio has helped, as well as thinning out the active managers over the past 10 years that weren't adding value and restricting it more to those that do. Moving down to core fixed income, I know John already mentioned a couple comments on this. You have outperformed very consistently versus the index. If you look at the peer returns on the next page, you're below median. My gut is it's a function of what John said. First of all, you have a non-core fixed income area that's carved out, and also having some more low duration and less of a credit exposure relative to peers could be driving that. Overall, since inception, I think it goes back 26 years, your top quartile there, and overall the performance has been very strong. Natural resources, it's a smaller allocation, but it's all over the map in terms of, this is just a volatile, it's a volatile area. When you look at this index, you're benchmarking against a commodity oriented index, and your natural resources portfolio, you have some volatility in it as well, but it's not going to be as volatile as that benchmark. So you do see quite a bit of tracking error. It's really tough to gauge this portfolio at this point, given that it's relatively young and just very volatile relative to the index. Real estate has been a great area for you. Not quite as good as US equity, but pretty close in terms of absolute return, almost about 10% net of fees. And I know Mike has already commented, but you don't have an exposure that is purely open-ended funds. You have private-oriented asset or privately kind of private equity structured assets. So you are quite different than the benchmark, which has changed a bit over the years. But the performance long term has been very strong for this area of the portfolio. And then private. Sorry.
Mark, this is just one thing I wanted to point out here that might be important is that you'll recall back in April, the board approved moving to the ODCE benchmark or back to that benchmark for the real estate portfolio. Because that's a quarterly benchmark, we were kind of stuck because we were in between quarters. And we had the US REIT index prior, which is daily mark. So we couldn't really go back and do the ODCE mid-quarter. So through the end of June, we're still benchmarked against the index, and then we'll be on the ODCE going forward into the third quarter because we just couldn't make that. We decided, that just didn't make sense to retroactively do it. And so anyways, just wanted to point that out.
Thank you. Yeah, and that's not going to make, that's going to wash out over time, but I think you talked about it in the last meeting, but it is more fitting. It's not a perfect fit by any means, but it is a more fitting index for the type of investments that you have in the portfolio. Cash is pretty straightforward. Again, the big message there is less about the relative returns and more about the fact that, you're not going to be earning as much on the cash that you have in the portfolio. Given the direction of interest rates, and it doesn't look like they're going to be returning to an attractive level anytime soon. And then finally, the private investments is kind of the typical story here, where you see that lagged effect. It protects you when you have a sharp sell-off, but when you have a sharp gain, it's going to lag that as well. Again, short term, you don't really want to be extracting any meaning from the deviations from the index here. But long-term, it has added, not quite at the level of public equities, given the run of the public equity bull market, but an attractive double-digit return net of fees over the past 10 years. And if you look since inception, which goes back almost 20 years at this point, really a same story and has really been additive to the portfolio. Moving on to page 10. I mentioned a couple of these, but you can see this essentially measures your asset class composites versus asset class composites at other public pension plans that are comparable to you. And the only thing I haven't mentioned, I think, is the international equity and real estate, the nature of those. International equity, as you recall, you are outperforming relative to benchmarks, but if you look back 5-6 years ago, you were definitely I think it was in the lower quartile for relative to peers. That's improved quite a bit over the past 5 years. We're right about median, still trailing a bit over 10 years, but you have again done some thinning of managers and also more of a passive presence there, and it does appear that is paying off. The other peer rankings that I didn't mention, it's a little harder to extract meaning here because real estate portfolios are very different among public pension plans, but generally you have performed well versus your peers here with rankings in the certainly above median for most trailing periods over the past 10 years, or at median at the 7-year mark. So in general, this kind of reiterates the message that Mike had provided earlier. The performance of the plans, particularly relative to peers, has been strong. One thing I didn't mention is the diversification. There is a slide later on that shows the beta. You have added portfolios that have provided strong diversification. You've avoided one in particular that is often used for diversification but has struggled, which is hedge funds. And overall, the portfolio is performing well. That's about all I have in terms of general comments, but perhaps we can open it to questions, or if Jim and Becky have anything to add, feel free.
Mark, this is Jack. At least in my book, you've been off on pages all along, but
sorry about that.
But anyway, on my book, which is page 46, it's a chart that we never look at, but I always look at it because it's in the book. It's performance since inception, benchmarks on our managers.
Where are you? Can you tell me like what?
So Mark, it's in the big book. It's manager performance since inception versus benchmark sorted.
Find it.
It's on equity composites section, maybe.
I have it in here. I apologize. I'll make sure I go off the other book. Maybe you can just describe what the question is. I think I know what you're referring to.
So anyway, the managers are rated compared to their benchmarks since inception. And my question is, for instance, Jacob Levy is one of the ones that's negative. And so I guess what I'm asking for, if you could find this page, what does this tell us, if anything?
I can tell you generally the things that we would look at and your staff would look at and triangulate. With managers, the tough thing, the thing that you're really looking for in a manager is, do they have a comparative advantage relative to the other talented people out there? And are they expected to be able to leverage that competitive advantage sufficiently to offset the fees that you're going to pay? And it's important to look at their track record. I mean, somebody who continuously underperforms every year, all else being equal, I think it's a fair bet that maybe they don't have that edge. But it's not the only thing that you look at. There is going to be a period in time that a manager is going to underperform, and sometimes that can be longer than you think. So it's a tricky balance to be forward looking, to take the track record into account, but also realize that that track record has a tendency, and I've seen it happen, when you terminate somebody, next thing you know, they're gonna outperform. It's kind of like a stock. You buy, when it's down, you sell it, and then all of a sudden it bounces back. So I can't tell you specifically about that manager. Maybe John or his team can comment on it, but that is the thing that you're constantly trying to manage, is weighing performance, but not exclusively thinking about performance. And then the shorter the term is, the less weight that would get in the decision, just because, you know, everyone's going to miss over a quarter. Gets to 3 years, you start getting a little more concerned. Gets to 5 years, you start getting definitely more concerned. But at the end of the day, the critical question is, do you feel, and do you have, more importantly, do you have evidence that they have an edge that is going to enable them to outperform in the future?
Jack, this is Jim. I have Jacobs Levy, the page in the shorter version of the book up. Are we talking about the 130/30 portfolio with the inception date of April 2018?
Yeah, and I know that's short, but my real question was not so much them, because they're at the bottom of this list on this chart, but just what does this chart tell me is what I was trying to get to.
Well,
not specifically. So maybe John, can you find that in the book, and could you help me read that chart?
Yeah, so I guess a few comments, Jack. You know, I mean, obviously the ones that are performing well versus their benchmark, great, we're probably fairly happy. Although I will say in some instances, you know, it could depend what benchmark we've chosen, or, you know, the manager benchmarks themselves against. And so that can be a factor. For instance, you know, as an example, they beat their value benchmark, let's say, but value didn't do particularly well versus growth. Well, there's still a decision that we might have to make there as to whether we want to maintain a value manager, for instance. I was commenting to Terry that, you know, you'll see, I think, all of the high yield managers here with slight underperformance to their benchmark. It's sort of what I would expect. It's an asset class where we can't get passive exposure. And so to the extent that I'd say on average, we probably, let's say, pay our high yield managers 50 to 60 basis points to be in the space. I think all of them have done at least mitigated their fee. So, and we kind of have to think about the type of exposure we want there. And we'll talk about that a bit more as we get into high yield next, I guess. But, you know, what's the sort of the risk reward trade-offs there? And do we want to be in a high octane manager with more vol than somebody who's not? So, you know, I think this is an interesting chart. Maybe, you know, to the extent that you have, if Jacobs Levy, for instance, if we had a 10-year track record here and they were at the bottom of this, you know, negative 344, I'd be a lot more concerned than I am over a pretty short time frame. And you know, Randy and team will tell you, yeah, they ran into some trouble here in the last 6 months or so as we went through the crisis. But, you know, we're still pretty confident in that manager and think they've got probably a pretty good opportunity to snap back. So each one's kind of an individual story, and I guess I'll leave it there.
So if I could, this is Jim from RVK. If I could make a couple of comments about the core of your question, Jack, which is, I now understand it. It's not about Jacobs Levy. It's about what information does this table tell us, and about what? Well, one is that it can tell you something about the manager. So, for example, as John said, if the manager has persistently through different investment climates continued to underperform a legitimate benchmark, well, then there's a question of whether or not that manager needs to be in the program, executing a mandate that you might need executed no matter what, but maybe they're not the right one to do it. Periodically, from time to time, for our own purposes, and occasionally in history, your two former CIOs ago has asked us to look at this. We've looked at the subsequent performance of managers that you have terminated. And to the extent that They were good decisions. What that means is that what it tells you about investment decision-making is not nearly enough. You have to look at the sum of your actions, not only who's in the portfolio, but who you've removed from the portfolio, and have that been positive decisions. As Mark said, generally speaking, you have made good decisions on average over that period, or your staff has, and that's what's led to the good portfolio performance. The other thing that we've already mentioned is it doesn't tell you anything, as John said, if the period is very short, or it is unlikely to tell you anything. The last issue which I would mention is that what does it tell you about how you've structured the asset class? It depends on what your options are. So a manager that's underperforming, to use John's example in high yield, underperforming a benchmark that you can't invest in anyway, then the issue becomes, if you want that exposure, you want the best manager that's available to execute it for you if it can't be done passively. And so all of a sudden then the peer ranking becomes more important than how they're doing versus a benchmark that you couldn't access even if you wanted to. So it tells you different things about, it tells you something about different things, about a set of different questions that you might ask. I know I've made that complicated, but you invited the question, so, or you asked the question and invited the answer. So I
wouldn't
plead
expect
innocent.
anything
I plead
simple.
innocent. I plead innocent.
Okay.
And I want you to know I didn't use a single metaphor.
Yeah, but you know, I don't care. That's only when Mark's in charge.
I know, he's brutal.
Yeah.
You know, the other thing to add, and you know, this, you saw this happen a little while ago, is really think critically about what you're adding to the portfolio is adding. And you know, that's in the context of the GTA strategy. So yes, they're adding a little diversification incrementally. Is it worth the cost? You know, not only in terms of fees, but the cost of distraction. And you need to make sure it is. And you know, that's just something, every time you add something to the portfolio, you know, it's important to think critically about whatever you're adding, is it worth it?
Okay, other questions for these people? Anything else RVK needs to tell us?
Just that, you know, given the fact of how tumultuous recently things have been, the portfolio is doing pretty well. Not all public pension plan portfolios or even endowment and foundation portfolios are coping as well as you are so far. There are challenges going forward. If you ask John about what he's thinking about the expected absolute return from fixed income, I suspect he will not be enthusiastic, nor will we. And you have what was called a nominal bogey, an estimated return that isn't relative, and therefore low fixed income returns are going to be a challenge for you. We also, I'm sure when Ethan talks about going forward, he'll talk about there are certain parts of the real estate market that are under a lot of pressure. And so the great ride that you've had in real estate over the past number of years is going to be challenged as well. But that's why you have the staff, and hopefully we'll be able to help. So I'll stop there.
So question, going back in time to the great financial crisis, one of the things that I think I remember happening was it was claimed that there wasn't sufficient stimulus to pull us out of that quicker. Am I correct with that?
Well, go ahead, Mark.
I don't know if I remember hearing that. It seemed like with the things that struck me about it were, it took a while, and I'm just speaking off the cuff here, it took a while for the Fed and the government to get their hands around the scope of the problem. Once Lehman wondered, things kind of spread beyond what people feared in terms of the contagion involved. And there was some uncertainty on, there was definitely some reluctance in terms of, I remember, TARP didn't pass the first time. So there were kind of there seemed to be an issue of, it was tougher to get their hands around the scope of the problem. And there was some reticence in terms of doing what was necessary to stable markets. And
we're on the same page. I didn't really want to stay there, other than now we're in another year where we did the first big, it seemed like the Fed and the legislature both reacted quicker and better. The question I have is the need for this second influx of money. Do you have any opinions?
This is where you get into the unknown area. Who knows? You hope that they're calibrating it correctly.
Let me try to take a stab at that.
Sure.
Whether it's the GFC, and the GFC was a perfect example of that, but March of this year was also a good example. There are two parts to a crisis in the financial markets. One part is the crisis of confidence in the market. And the other is the actual diminution of in front of you, the value, economic real growth, earnings, and all that sort of thing. What happened, and I agree with Mark, that the delay in the Fed and the fiscal authorities in appreciating that confidence had to be restored was part of the reason why the decline in the GFC persisted longer and was deeper, certainly persisted longer than the COVID decline. And once confidence was established, then real economic growth, even without, I don't buy necessarily, but I'm just one opinion, that it was insufficient stimulus. The fact is the economy grew and eventually job creation grew very, very nicely, to the point where the Fed felt it actually needed to raise interest rates. So we went through the same thing here with COVID. We had a period of time where even the Treasury market was not acting well, and we didn't have that in the GFC. That's a crisis of confidence in the marketplace. And the rapid response of the Fed and fiscal authorities have straightened out the market and taken away the fear of the market not working. And you see the results certainly in the equity market. And actually the bond market has performed reasonably well as well. But Mark, I think, was hinting at all things come at a cost, and we don't know what that cost is in the long run. We do know that government debt has exploded on the upside. We do know that the Fed's balance sheet has exploded on the upside. And we do know that interest rates are, as close to zero and uncomfortably close to going negative as I think we would ever like them to be. And so no one knows what the longer term consequences of that are. Sometimes, you heal the patient and you hope that things will be fine, but sometimes there are long-term costs to what you feel you either have to do or you did anyway today. And that's, I think, the uncertainty that Mark is referring to. So I'll stop there if that makes any sense at all.
And of course, the unusual thing about this situation is we've never been in a total economic shutdown as we were in the COVID crisis this time. So it's different in that aspect. And so the discussions on the next round of CARE stimulus is dealing with that. Obviously, the Fed acted so quickly, and Mark's right, in the series of a month, and actually it was in 9 days in some cases in taking original action. So it differed from the financial crisis in 08 and 09, and then it didn't start with the financial markets, which is where the financial crisis started in 08, 09. This time around, every effort was made to try to shore up the financial markets to make sure that they were working properly. I would say, though, that even though the markets make it feel like we're out of the woods from an investor's point of view, the economy is not. And so we do think that this quick snapback, it makes us all feel good, and the numbers sure look a whole lot better than first quarter. But keep in mind the financial markets are ahead of where the economy actually is, and we have a lot of repair yet to go, and still more carnage in terms of smaller businesses and not so small businesses that may not make it. So this will be one for the history books in terms of this interface or interaction of economies and a big pandemic and the response of economic shutdown. But you know, the good news is that the Fed is prepared to do basically anything in their definition of that to get us past this valley.
And not all parts of the capital markets are signaling the kind of exuberance that you see in the equity market. In the, you know, fixed income yields are interpreted by many as exactly what Becky said, that the economy is not out of the woods. Number one. Number two is you've seen the big rally in gold. That might very well indicate that there's a substantial portion of the investor universe that thinks that we're not out of the woods. And the third thing that's interesting and different is that the value of the dollar against the euro, which we love to make fun of, the euro and the union, but the fact is that the dollar has weakened against the euro fairly appreciably, and you'll see that showing up in the performance of your international equity and fixed income exposure over the remainder of the year. So the signals that we're getting from the marketplace are mixed about what investors think is going to happen over the next 3 to 5 years.
Yeah, Jack?
Go ahead, Bruce.
Yeah, I just a couple of things. One is kind of a follow-up to what Jim might have been getting at, and that is that one of the differences between the overall governmental response between the great financial crisis and now is that while they were late in getting around to the monetary Fed stimulus in 2007, 2008, unlike now, there was the monetary stimulus both times. But the fiscal stimulus, on the other hand, last time was limited to the Recovery Act spending, which was principally on infrastructure development. And this time was largely directed toward individuals and businesses at a smaller level. Well, there was TARP last time as well, but this is the first time we've seen, you know, $1,200 checks put in the hands of 150 million Americans, and the not letting evictions go forward and things like that. So the stimulus was in large part directed at a different level this time than it was in 2008. And I think maybe what Jim was getting at more, and what I'd like your thoughts on, is how much more of that kind of stimulus, fiscal stimulus, do we need now for the broad consumer base out there so that we can just afford to live and function on a day-to-day basis, pay our bills, pay for food, pay for utilities, pay for roofs over our heads.
I'll let Jim answer it in more detail, but I think it's hard to know. I mean, this is where it comes down to thinking long-term, sticking with long-term, because it is very difficult to know how the economic situation is going to play out at this point. I mean, the last comparable is really the 1918 Great Influenza, but it was a very different economy and it was a different world back then. And you know, there's actually an interesting book by Ray Dalio. It's called Navigating the Long-Term Debt Cycle. And aside from COVID, that's one of the challenges that we've run into right now, where you've had, I probably won't do it justice, but essentially since the 1940s, you've had a series of business cycles. And with every business cycle, the Fed has lowered interest rates debt has gone up, and you come out of that business cycle. Then the same process repeats over and over. And as we've repeated that process, the mountain of debt has gotten up to the point that interest rate policy alone does not work. And that's when the money printing starts. And, essentially what you've seen starting April 9th was the beginning of debt monetization in the United States in order to support an economy, because the Fed has run out of firepower on using interest rate policy alone. So how that pans out is a big uncertainty, but that's essentially the era that we have now entered. At least for Dalio, and it's pretty extensive research.
So Bruce, your question is, your comment about the difference between the GFC and COVID is spot on. You said it so well. If you think back to the GFC, what we were worried about was banks failing because of the heavy leverage in the financial system and the interconnection with derivatives, et cetera. And so the response of the government was targeted largely, I will say largely at making sure that the financial system stayed secure or was secured. They succeeded at that. And in fact, the stress tests on banks and the higher requirements for reserves have worked very well. The banks have not, they may not be doing great business, but they're not in trouble because of COVID. And that's a positive legacy, I guess, of the GFC. But when you ask the question, does the government need to send more checks directly to individuals? Number one, we don't know the answer to that. I'm not sure that anybody really knows. Somebody will make a decision about it, but I'm not sure anybody knows. And the second thing is that at this point in the debt cycle, the grand debt cycle, it's not a question of do we need more or do we need less? It's that if we feel we need more, are we comfortable with the longer term risks we take of printing money, borrowing it essentially from future generations? And I'm talking not about way in the future. I'm talking about, children and grandchildren and great grandchildren, some of which I have, 2 of the 3 I have already. So that's the balancing act. If looked at compartmentalized, the answer is there's always people that need more money. The other question is, can the government, what is the appropriate balance between the government running these big long-term risks and printing money and sending it to individuals? It's way above our pay grade, I'll tell you that. It would be nice if we put it in the hands of this board because they're so thoughtful about it.
Well, John Putnam, you were around in 1918. What happened back then that we could replicate here?
Go ahead, John. You don't have to answer.
Jack's twin passed away in the pandemic.
My 103-year-old grandmother was around. I can comment her.
So anyway, if RVK can't solve the world problems, we might be done.
We must be done then.
All right. Well, it was a good attempt anyway. Thank you, guys. We're due for a break. I don't want to go too long.
What time do we got now? 2:11. You want to take 2:30?
2:30, perfect.
Okay.
So we'll re-meet with 2:30 and continue on with our agenda. Thank you.
You got Bruce. There's the board. We're just smart. Let's see.
I haven't seen him all afternoon.
Yeah, he was on a little bit.
There's Jason. We need him.
Yeah, we
Meet Jason.
So I've got it on speaker view. So when he talks, he'll take up whoever's talking gets
I
the
like
big
that.
screen.
Good.
Tell all of our imperfections. I have a zip right here. I got to take care of. I found out.
No.
No.
Oh, you're such a jerk. I'm going to show you my sister made these for my wall. grandma.
Aw,
And that was a t-shirt, a sweatshirt with all the grandpas and all the different things, and she framed it.
oh, nice.
My granddaughter's gonna call me Grandma.
Oh, that's good. She could call you a lot worse.
Yeah, sure, I'm not going for anything.
Just say you'll have to show it to the screen so we can all see it.
We're on. Okay, now we are getting a little off schedule.
I have a new grandbaby, so I'm always showing her them.
Oh, well, you've got to then. Or email.
Yeah. So we'll reconvene. I told Dan we'll stay on schedule, but we're going to stay way ahead of schedule.
So can we start on that real quick?
Sure.
So dinner tonight, Jim, Sheila, me, John, Jill, Jeff.
Terry.
No, Terry has unexpected company. Diane,
Yeah.
anyone else?
Freaky out, but that was my visitor last week.
Yeah, so, Lindsay, can you call, and John, does it work for you if we do like a 5:30 instead of 6:30?
No.
Or is that too early?
No, it's fine.
Okay, Lindsay, will you call and
Early
see?
today.
Okay, Lindsay, will you call and see if we can move that to 5:30?
You know, it's an aging board. They've got to be home in bed early.
This needs all the beauty sleep it can get.
That's why I'm not going, I'm going to bed at 5:30.
All right, I digress. Thank you, Mr. Chairman.
All right, well, we've got our scheduled important thing, lunch, and now dinner. So we get to hear from Jason. Jason is going to talk about non-core fixed income. And so you've got a nice board book stuff here, Jason. I want to compliment you on that, and I'll turn it over to you.
Mr. Chairman, I'm gonna do the first couple slides here, if that's okay. And then I'm gonna
No,
turn it
I'm
over to
sorry,
Jason.
but I talked to Jason, not you.
You said no? Okay. That's
No,
fine.
I'm just kidding. Of course, you can talk anytime.
All right, well, I'll start out with, in Jason's presentation, somehow or another, we left off his Kaya designation on the front page, but he's got CFA and Kaya, so we want to, oh, it's there on the online one, so that's
You can
good.
see it on the screen. There's some
Good.
issues with the paper hard copy.
All right, well, on slide 3, the first few slides, I'm just going to go over non-core fixed income in general, then I'm going to turn it over to Jason to go into a little more deep dive on the high yield space. So as you know, our improved allocation range currently for non-core 3 to 7%. We've got high yield, convertible debt, preferreds, and emerging markets debt all approved within the investment policy, but currently we're only in US high yield. As you know, we're in the process for both preferred and emerging market debt. And as we're able to complete our due diligence processes there, we will do so and hope to have some more information on managers that we might hire, I guess, in the future at maybe the October, hopefully the November meeting. Some of that dependent on travel, of course, as we've talked about. So on slide 4, just a quick description of the various investments. So high yield, I'll just kind of leave that to Jason to go into in more detail. Convertibles, similar to other bonds, but they're subordinate to the senior debt. So when you think about the capital structure of a company, they might have senior debt, then perhaps convertible debt subordinate to that. So they would be paid if they were to run into trouble. The convertibles would get paid after the senior debt. Convertibles, they pay a fixed coupon payment, and so that's something that is attractive. And they would similarly be kind of a higher yielding coupon typically. And then they can be converted into common stock, and that's generally at a specific predetermined amount at the discretion of the bondholder. So if you're in the money, as it were, for the option of converting into common stock, the bondholder could choose to do so. Then if we went further down the capital structure, we'd get into preferred securities. So preferred securities really is preferred stock, and the income comes from a dividend payment, not coupon interest. And the preferred stock would be subordinate to all the other classes of debt, senior or subordinate. But they've got priority for their dividend payments to the common stockholders. So we've seen it in the past in, say, the GFC. Oftentimes the preferred coupon or dividend payment was left on, while common stockholder dividends may have been turned off. But you're at greater risk of loss should the company actually go bankrupt. And then emerging markets debt, obviously, kind of a different world altogether, just senior debt typically, but issued by sovereign or quasi-sovereign issuers. And there we get into really more the sovereign risk, could be denominated in dollars or in some cases foreign currency. So it could be foreign currency risk there as well.
John, can I ask a quick question? When a company's deciding whether to do convertible bonds or preferred securities, what sort of things do they look at? Are there tax benefits of doing it one way or the other? Or?
That could be one factor. It could be it's the cost of capital, generally speaking,
So just where the markets are at
and
that
where they
point.
can issue. But one thing I would note that is pretty interesting as you get into some of these, different areas, and I wouldn't say, they're a little bit niche, I guess, not as big a market here in, say, convertibles and preferreds as certainly there are high yield or more senior bonds, investment grade. But convertible bonds are interesting because the mix of issuers is very different than other areas. So for instance, there tend to be a lot of tech companies in convertible bonds. They tend to be, there's a pretty good concentration of private companies. So you get exposure, perhaps similar to a private equity context, I guess, if you will, in the convertible debt space, that you might get access to some people that you wouldn't otherwise access at, say, a senior bond in the regular investment grade market. Preferreds tend to be very heavy in financials. So they're very heavy in banks and insurance companies. And so there are some.
And it used to be utilities, right? But not so much anymore.
And there is some of that, but it's not as much. So you do get some different flavors here. And when we've looked at these within the public markets team, we're kind of cognizant of the exposure that you're likely to get there. And we've talked a lot about, is that something we want to have access to or not? So there are some kind of unique differences there.
Terry, this is Jim, to your question, dating back to my old investment banker days. The reason that as John said, you see so many tech companies tend to be overweighted in participation in the convertible market is that the number one reason for doing so is the company thinks its stock is undervalued and they're going to grow a lot, and they don't want to issue equity. And so what they decide to do is they'll bear the consequence of an interest payment, because typically many of these companies don't pay dividends on their common stock, and but set the convert price to a price much higher or as high as they can get away with to their current price of their common equity. And so that in that way, they are essentially paying a price to issue equity at a higher rate. With preferred securities, a lot of financial institutions get preferred treatment for permanent capital if by their regulators, whether that's insurance companies or banks. And so they like the notion of selling preferred securities for almost regulatory industry specific reasons. Did I miss anything there, John?
No, that's exactly right. And there's a limited amount of preferred that can be used for capital purposes. And so I guess in some ways that's why it's a niche, because it can't be a big chunk of your capital structure. I want to say it's like, I think it can be 1% or something like that. So it's relatively small, but most of them do it because it is advantageous for at least that portion that they're doing it for. Let's see, moving on to slide 5. So why do we like non-core fixed income, or, what attracts us here? So the first 2 bullet points are kind of, tied at the hip a little bit, current income or higher yields. This has become, as you know, particularly important as rates have dropped to, virtually zero in the investment grade space. We're, certainly sub 1% on the 10-year treasury. I think, I don't remember the exact number, but I think our yields within our investment grade core fixed income are, right around 1% all in for the ag at this point. So to be able to go into an asset class and be able to, get that current income stream and a higher return has become increasingly important for us, I think. And there's not a lot of expectation in the market, as we've somewhat talked about, that rates are going to go back up. I would say not in the near term, and perhaps not in the intermediate term. As I think Mark kind of laid it out, we've had these multiple cycles, and you can look at the yields over time, and it's not a straight line down, but there hasn't been a lot of uptick. We certainly tried post GFC. It took us almost 10 years before we kind of started raising rates, and now we're kind of right back or lower than what we were before. So very attractive to expand our horizons here a little bit and to find some yield other places. There is some advantages in terms of the lower volatility than equity, so we get to diversify a little bit. It does vary significantly among the sub-asset classes, so I would say, preferreds might be somewhat closer, as they're closer to common stock in terms of their movements. EMD, as we've talked about a little bit, is probably the best diversifier that doesn't have, doesn't move as closely with, say, our domestic equity portfolio. But all in, you get some level of lower volatility, better diversification by being in any of these asset classes. And so, that's an advantage as well. And lastly, I would just note that, and Jason will talk about this a little bit more with high yield, and I alluded to it earlier, I think it's very important when we're talking about some of these asset classes to recognize that the benchmarks aren't that great. There are benchmarks here that we utilize, but we can't invest in them passively. We're not going to track closely to them. And so at the end of the day, I think we need to be more concerned about what's our absolute return here. Is it reasonable for the risk that we're taking? And not necessarily be exceedingly concerned, similar to high yield, that, hey, maybe we cost us 25, 30, 40 basis points to be in the asset class versus, negative to the index. If we still got a 6, 7, 8% return or something, I think that should be attractive, and we should be happy about that. And we need to think about, when we're looking at the managers, what kind of risk is that manager taking? Do we want to be in the more high octane manager that perhaps does beat the index, but with a whole lot more volatility? These are all considerations that we think about, and I think we broadly, to the extent possible when we're looking at these things, would prefer to be in a manager that's going to show us a little bit less volatility, a little more downside protection, if that's something that they can offer for that particular sub-asset class. But, that risk reward trade-off is of greater concern than just beating a benchmark. So happy to take any other questions. Don't have any, I will turn it over to Jason to dive into high yield. Take it away, Jason.
All right, thanks. I'll be starting on slide 6. So high yield bonds are bonds issued by companies with a below investment grade credit rating. And you can see the table below at the bottom of the page that shows the rating scales for the major ratings agencies. And so anything below BBB for S&P and Fitch, or anything below BAA from Moody's is considered below investment grade or high yield. High yield bonds have these lower credit ratings due to potentially a number of factors. It can be higher leverage, a company just carries more debt. It can be a company in distress or having financial difficulties, or it can simply be a smaller company or emerging company that has less proven track record. Moving to slide 7. Some of the characteristics of high yield bonds. So the US high yield bond market is only corporate bonds. There are no treasury or agency securities. High yield bonds have higher yields as reflected by their name, that higher yields than investment grade bonds to compensate for higher credit risk. They have short to intermediate term maturities. So the longest maturity high yield bond is going to be a much shorter maturity than the longest maturity investment grade bond. High yield bonds typically have call provisions that provides the issuer the right to buy back the bonds and retire them. So say if a company's financial condition or its credit rating improves, it can call the bonds, buy them back, retire them, and they can then reissue new bonds with lower interest payments. And what this means for investors is that they lose out on these higher yields for a longer period of time and then have to reinvest in bonds with lower yields. Slide 8, some of the risks of high yield bonds. High yield bonds are more sensitive to ups and downs in the economy than investment grade bonds. Higher credit risk than investment grade bonds for the reasons we mentioned earlier. Downgrade risk, typically we think of this as a factor for an investment grade bond that gets downgraded to high yield. But to downgrade for a high yield bond can also affect the price. Think of it as a negative signal or bad news that's being delivered to the market. Interest rate risk, rates go up, bond prices go down. And liquidity. So high yield bond market really is a semi-liquid market. It can be difficult to access some bonds. The bonds are traded over the counter. Almost none are traded on electronic exchanges, which makes them costly to trade, and trading can have an outsized impact on the bond's price. Slide 9 shows our current portfolio and our 3 managers. The current exposure is just below the midpoint of the approved range at 4.4%. Some of the common characteristics of the 3 managers really 2. First is they have well-diversified portfolios, and 2, they have a conservative bias in their approach to investing, which is very important in fixed income, since the best you can do is to get back your principal and your interest. Page 10 shows the current exposures by credit rating and by industries. You see by credit rating, we're most overweight in single Bs, which is common. There's a term in the high yield bond market known as the single B sweet spot, which is where managers like to play. That it gives them higher yields than they could get with double Bs, but also lower credit risk than triple Cs. The bottom tables show our over and underweights by industry. And you see, the exposures there. I'd note, one thing to notice too is the high yield index exposures to 2 areas: communications and energy, which is the weights in the high yield index are much larger than what you see in the U.S. equity indices. I'd also note too, if you go back to credit rating, the quality in the high yield market has increased over time. Double Bs are at the highest percentage they've been, I think, maybe ever. And triple Cs, which were 20% or more pre-GFC, are now around 12%. Next slide is if you talk about the current environment. I have it labeled number 11. I think the hard copies maybe a little off. But current environment, a lot has happened this year. High yield spreads peaked at 1,100 basis points with the market sell-off. They tightened significantly in the second quarter, but spreads still are higher than their pre-COVID sell-off levels. Now they're around 500 basis points. They started the year in the 325 to 350 basis point range. Defaults are expected to rise. They're currently at 6%, and some forecasts are calling for default rates of 8 to 12% in 2020, with energy being the hardest hit sector. Downgrades have increased significantly, and about 250 billion of fallen angels have entered the high yield index. A fallen angel is an investment grade bond that's been downgraded to high yield. Ford, Kraft Heinz, Macy's, Delta, some of the big names that have been downgraded. And two, we talked earlier, when RBK was talking about the Fed actions, the speed of the reaction to the Fed. I would say the magnitude of the reaction. One of the things that we didn't talk about really is that they got involved in the high yield market, which was a bit of a surprise, and was something they had not done before. That they committed to buying fallen angels and buying high yield ETFs. And these actions really helped keep the credit markets open, both in investment grade and high yield. Companies could raise capital, issuance hit record highs. And what this, I think, really means, at least in one respect, is that the default rate for 2020 is probably going to be, I think our managers would say, toward the low end of that 8 to 12% range. As companies have, in raising capital, have increased financial flexibility and ability to weather the storm, at least for the time being. The next page speaks about due diligence. Go ahead.
Could we go back for a minute to the current exposures? After the great financial crisis, there was a lot of skepticism about rating agencies and the job they were doing. And you were just pointing out that, we've got more, the quality appears to have gone up in the ratings. Do you feel relatively confident with the rating agencies' rating systems?
Yeah, I think a few points on that, since it's come up before. What's key here is that each of our managers has their own rating system. They score credits, they compare them to the ratings agencies. Second is that the ratings agencies tend to be backward looking. And many times the bond's price will have already reacted to news in the market before the credit rating agencies have changed their rating. Third, these are not CDOs, so there are issues with how they model the risk in CDOs. This is not that, these are corporate bonds. And I think generally speaking, the ratings agencies prior to this year, I think our managers would say, had been giving the BBB credits, those are the ones at the lowest level of investment grade, have been giving them quite a bit of leeway. And when the sell-off hit and the COVID news started breaking, they sharpened their knives and were very aggressive in downgrading. So typically the ratio of downgrades to upgrades is like between 2 or 3 times. So more downgrades than upgrades. In the last few years, that's been closer between 5 and 10%, or 5 to 10 times more downgrades than upgrades. And that's the case at least more recently. So, I think that, again, the key point is, how much confidence do we have in the ratings agencies, understanding that they're pretty much backward looking and bonds price may reflect news that's not there, and that our managers have their own systems for rating credits independent of what the credit ratings agencies do.
Thank you.
So moving on to slide 12, which is titled Due Diligence and Monitoring Process. The process we use is the same one we use in the domestic and international equities. We do quarterly reviews. We have calls with our managers every quarter. We have manager scorecards where we rate the managers on a number of different factors, investment guidelines that we create and monitor for compliance with help of the risk management team here. Periodic on-site visits. We've visited all their managers. I've visited some of them multiple times. And Bloomberg Port. Bloomberg Port is a module within Bloomberg that allows us, it's a portfolio analytics tool that allows us a couple things. We can monitor the sector and credit rating exposures. We can look at portfolio characteristics like yields and duration and number of holdings, sector and credit ratings attribution. So we can break down the performance by credit rating and by sector to determine the drivers of performance, what the manager did well and maybe what they didn't do so well. And we can drill down to position level and analysis to look at individual bond credit ratings, the price changes in those individual bonds, changes in positioning, or trades in those bonds too. Next page, 13. In summary, really to reiterate, first and foremost, the objectives in the non-core fixed income asset class. First, current income, and two, higher yields than core fixed income. And we can get that at lower volatility than equities. The current exposure is only a high yield, but we have the flexibility to pursue other strategies, as John mentioned, in preferreds and emerging market debt. The monitoring process and due diligence process is the same as we do with public equities. And our portfolio currently shows managers that have well-diversified portfolios and tend to have a little more conservative bias in their investing approach. So that wraps up my comments. Any questions?
Level, when we're trying to see what you're doing and you do your presentation to us, is there some key points that we should be looking at to make sure that we feel comfortable with the risk that the managers are taking and their performance, other than just what would be reported like from RBK or something?
Well, the aspects we rate them on, I mean, first thing you look at performance, but as John mentioned, performance can be misleading if you're looking at versus a benchmark, given some of the issues that we've talked about. In terms of the risk they're taking, that's a little bit harder to look at in these presentations. But if you look at, well, take the first quarter, for example. If you look at returns, we don't have the first quarter returns on here. We have the second quarter and trailing year. But if you told me this is what the market's going to do, which managers are going to do better and which ones are going to do less well, I guess. It turned out exactly as expected. That Shankman tends to be more conservative, Oaktree is kind of in the middle, and Neuberger is more of a, even though they have a conservative bias, more of what they will call a full cycle manager. They will make bigger moves in certain cases, which tend to be pretty rare, where they will take more risk and either dial up the risk or dial down the portfolio. Oaktree and Shankman tend to be more consistent in terms of their exposures, either by credit rating or by sectors. But when would I look at too is to look here. Obviously on page 10, the current exposures, you see the aggregate exposures. You would see as it adds up, we don't have a huge overweight to triple Cs. If we were really overweight, if a manager was really overweight in double Bs, that might seem as being very defensive. But what they would likely be doing, number one, they would have very low yields, and they'd probably be taking a very huge duration bet because a lot of the double B bonds are much larger, longer in duration. So, outside of just what you see on here is, I guess, the comments from staff. And like I gave you the example of the first quarter, In the second quarter with a rebound, if you told me again, things are going to rebound, who's going to do best? It would have turned out exactly as I would have expected. So with first and second quarters, I think things have been as expected through the first half of this year. And at least through yesterday, all the managers are close. Two of the managers are slightly above the benchmark, one slightly below, which given the environment we've had is pretty good. I think going back to one of the points we talked about with RVK and the effect of the Fed's response is that it has not only probably reduced the default rate for this year, but it's prevented some of the credit separation from the good credits and bad credits and pushed that out further into the future. So I think our managers will probably be disappointed with the Fed's action because it lessened the reward for having downside protection and kind of had that effect.
This is, I'm sorry, Jason, I didn't mean to interrupt. I just wanted to say to the question that was asked about, are there risk statistics for managers like this and fixed income manager generally that aren't routinely reported to you by RVK? The answer is yes, but your staff knows them very well. And we know them as well, and they can be found, but they're at one level below the sort of reporting level to the board. So for example, the duration of fixed income instruments is obviously something that your staff watches. Credit risk, and you saw it on Jason's chart, as best as you can determine it by using the rating agencies and the allocation of the portfolio to those various levels. Rating agencies have been pretty undependable. We agree with Jason, but they're all we got. The third thing that I like that he mentioned is that you want to watch the behavior, particularly of something like a high yield, the behavior relative to the equity in the portfolio, what we call the hidden equity beta in fixed income instruments, because it adds to the volatility of the total portfolio. And that can be tracked as well. Industry concentration, he mentioned that, and concentration in specific securities. So, you know, there are well-known sort of characteristics that are looked at with respect to trying to assess how much risk a manager is taking. Jason, did I speak out of turn on anything? Don't hesitate to correct.
No, I just wanted to make sure with Jack that I answered. I went on for a long time answering your question. I want to make sure that I answered it in the way you got the information you needed and all that I said. But
I did, yeah. So, you know, I always like to ask somebody about risk at least once a meeting.
Jason, can I ask one more question?
Sure, go ahead.
Jason?
Go ahead.
Go ahead, Terry.
Okay. Could you flip to the last page, that's Appendix A? Can you remind me what high yield spread to worst means? I think I know, but.
Right. So if you look at high yield, going back to the issue that high yield bonds typically have call provisions in them.
Oh, so if they were called.
If you look at a bond's yield to maturity, say it's a 10-year bond that's callable in 3 years, you might be getting an inaccurate picture of what your true yield would be looking at the 10-year yield. So yield to worst means yield to that point in time when the bond's first callable. And so the spread, which is the spread, is the incremental yield above treasuries that refers to there.
Right. Okay, thank you.
Other questions for Jason? Anything else, Jason, that we need to know?
That's it for me.
Okay. Well, thank you. That was good. So the next time we'll move on now, and I think the undisclosed location of Louise might still be undisclosed. Is Savannah going to do that, or where are we at?
Hello, everyone. Yes, Savvy is the one that's going to take care of that for us. Thank you.
Is it all right that I call her by that name now from now on?
I
I've
will
been
get
called
that
worse.
to Savannah.
All right, good afternoon, board members. I am going to present all of the fun intercap information to you that we have. We've got some extra stuff too, so buckle up. We're going to go ahead and start with our activity summary. And that is under tab 6, page 193 if you're on the electronic version. So this is the standard format that we always present to you. We ended up with over 29 million in fundings for the fiscal year and 27.5 million for commitments. I'll also note that we still have that little footnote for our decreased interest rates. That only goes until August 15th. It's the 18th, so we're done with that, and we're back to our 2.5%. And that'll go through February 15th of 2021. Are there any questions on the activity summary? No?
Oh, go ahead.
Okay, great. So we'll go to the staff approved loans that have been committed from April to June. This go around, we have 11 loans committed, which is much better than the 5 we had presented to you last meeting. These are all repeat borrowers. The 11 loans here total about 3.1 million in committed fundings. And I kind of like that the map is pretty well covered. So that's always good to see. Are there any questions on this?
Is there any one of those particular borrowers that were hard to approve or had extra risk? Or are they all pretty standard?
You know, I think that they were all pretty standard and easy going to work with. We've got some smaller communities and smaller places that we were extra happy to help out. So no, everybody was very well behaved.
Do you say that about the board?
Of course.
Yeah. Not enough candles on earth to get you out of that one.
Yeah, but you know, disinfected candy maybe.
Ah.
All right. If we're done with that, we will move on to our extra fun. This is our annual loan detail report. We present this to you every August at the end of the fiscal year. This just lays out exactly what we've been doing. The first page is a memo that notes our loan concentration. The only thing I really would like to mention here is that you can kind of see from last fiscal year, fiscal 19, we had cities as our biggest percentage of total outstanding loans. They flipped this year with counties. And then university, of course, that dropped a little bit, pretty significantly actually, because of that payoff from that happened last fall. After that, we have all sorts of fun on the next following pages and pages and pages. So I'll go through this line by line, if that's okay with you. I'm kidding, I'm not going to do that at all, because you moved up your dinner reservation. I actually only have a few little things to mention here, and then if I have questions, I can tackle those. So these are broken down by 3 bigger categories: local governments, universities, and state agencies. My biggest comments I want to make on local government is actually on the second page of that pretty lengthy report. Right in the middle there, you'll see several line items that say Missouri River Medical Center. We should have rolled those up. The ones that say purchase a CT scanner, that's the same loan, just separate draws, and we didn't roll them up to one line item. So that's our mistake. Same thing with the the replaced backup boiler, that was the same loan as well, just separate draws. Then, let's see, down at the bottom, there's 2 line items for SCOBY, and there should be. Those are 2 separate loans. However, in June, they paid off that first loan of the 1.8 million, and therefore released that remaining commitment of 636,000. We just didn't take it off the report. So that's our bad. But they did release that commitment. Are there any questions on local governments?
It's the COVID thing. Oh, go ahead.
Oh, could I just, Savannah, really quickly, under
Yeah.
Lewis and Clark County,
Yes.
the blessed parking meters that everyone is so thrilled with, I don't
Yes.
see that loan here.
It should be, let's look here.
Well, how am I missing it?
We took it off so we didn't have to own it.
We didn't
I
want
see
to
it. I was
talk about
only
it,
Lewis and
Terry.
Clark. I see it,
It
never
is there.
mind.
Yep.
I was just hoping maybe you made them give it back or something.
Well, we are making them pay it back, if that helps at all.
Parking meters.
Or that's what's it called?
Is there anything else
Savannah,
on that? Yeah.
Yeah, just in general on governments, with the COVID thing, is there any way we monitor our risk on some of these loans that are already done? Or have any idea that maybe the risk profile has changed? Or do we hear any negative things from any of these people?
I have not heard any negativity yet. And as far as I know, everyone's paying and up to date. Our borrowers are pretty good at communicating with us. I'll defer to Louise if she has any other insight on that as far as looking into the future, if we see a bigger problem, but I don't at the moment.
So usually, thank you, Mr. Chairman. Usually what we do when we do our review is that we're actually looking 2 years behind us. And so I do understand when you're looking forward as to what can we expect from our borrowers. I would say that our borrowers are very reliable with their payments. I do not foresee any of those going into a default scenario. Something through the inception of our program, there have been various challenges that local governments, the universities, state agencies, that sort of thing have gone through. And all the way up to this date, we have not had any defaults on our loans, that we have not suffered a loss. So I really believe that continuing forward, we're going to maintain that. And because we are dealing with local government, they do have a lot of different avenues of revenue, more than say someone in the private industry. So I feel confident that our borrowers are going to be on time as usual, and we will be prepared and deal with anything that comes up on a case-by-case basis.
Thank you. Any other questions? Well, Savannah, you did a good job. See, it's not as hard as Louise told you it'd be.
She likes to prepare me though, so that's good.
It is. Okay.
Thank
So
you.
Dan, we've kind of moved along pretty good.
We are only an hour and 45 minutes ahead of schedule. Everybody feel free to text the chairman and let him know. So Mr. Chairman, we're scheduled to convene again tomorrow at 8:30.
Mr. Chairman, hey Dan.
Yeah.
If it's at your option, but I texted Thomas and John and Kirsten, if you wanted to move forward with commitments and the policy statement stuff for them, they would be prepared to do that today. But if you want to save it for tomorrow, that's fine.
So we actually need to vote on the policy statement, so we probably should wait on that. But the new commits if you want to go, we can go on that, or if you want to wrap up a little early, it won't take much time tomorrow at all.
So tomorrow is kind of a short day anyway, so I think if it's all right with you, John, we'll just call it a day here.
I'm with me.
And that doesn't mean you get to go home early, but the rest of us do.
I never do.
And so we'll reconvene on the regular schedule tomorrow at 8:30, and thank you all. Good job.
Thanks, Jack. Good work.
This is Fred. I won't be on at 8:30. I'll join you as soon as I can. Thank you.
Did you get that picture?
I didn't.
Thanks, everybody. See you tomorrow.
Thank you.